Okay, so we in the last class we have discussed the first 20, 21 odd accounting standards. So we'll complete it. So we are having around 38 to 40 accounting standards. So in brief, I'm going to tell you what it is about. So the next one is accounting standard 22, which is about accounting for business combinations. So here details about any combinations of business, or maybe you have taken a joint venture or something extra, you have collaborated with some other firm. So all those details about how much money spent, what is the revenue earned, what are the overheads, all those details will be given in this accounting standard 22. The next is 23, which is capitalization of borrowing cost. Now what is the what do you mean by capital? Yes, anybody? What is capital? No? Okay. So capital is, in simple sense, investment needed to do something to start a firm. So when you talk about capital, we have two types of capital. We have long-term capital, which we use to buy assets, to make the infrastructure and so on. On the other hand, we have one more capital called as working capital. Okay, so working capital is that money which is needed for day-to-day operations. Say I want some amount in the bank, in cash, so that I can pay my bills, I can pay the employees, raw materials, overheads, rent, and so on. Okay, so sometimes you take a loan, a huge loan. Okay, so when you take a huge loan, the interest on that also is huge. So that borrowing cost, okay, say for example, you are processing a huge loan, that cost of borrowing, the transaction is also huge. And if you debit it in 1 year only, it will eat up a huge amount of your profit portion. So when there are huge borrowing cost, some companies try to capitalize it, means you are showing it as a long-term loan and you are going to debit it every year in bits. Once of all, you if you just debit it as expenses, then it will show a huge loss or the profit will be less. So when there are such expenses, so which are huge, even say for example, sometimes even the advertisement expenses are huge in crores together, they capitalize it. Capitalizing means I'm not going to show it in 1 year only, I'm going to cut it into bits and parts, I'm going to debit it over the period of next few years. So any such thing is given in accounting standard 23. Next, related party disclosure. So related party disclosures means the owners, the board of directors, or anybody who is related to your business, and you have to disclose them about, say, particular things, the amount of profit made, the cost, how much they have taken back their investment, have they taken any other loan from your company. So the investors or the person from the board, if they have some you say transactions between the company and them, so any such inflow or outflows between the owners, board of directors and the company, such details are given in related party disclosures. Next, accounting for investments. So whenever there is extra funds which they are not using, or it is excess fund and they don't want to buy any assets, or there is no need to buy any other assets, so some extra funds are invested in other buying shares of other companies. Such details about how much investment made in which company, at what cost it was purchased, what is the dividend you are receiving from that shares, also, or maybe you have kept an FD in a bank, any such investment made, the details about it is given under accounting standard 25. Then accounting for and reporting of retirement benefit plans. So you have employees, you have to plan for their pension, for retirement benefits, gratuity, all such details about the number of employees, how much they have paid monthly, what is the employees contribution, the employer's contribution, how much you're going to pay in as gratuity, what are the system, all such details are given in Accounting Standard 26. Then next is consolidated financial statements. So consolidated financial statement arises when you have more than one branches or you have subsidiaries in different countries or different locations. So subsidiaries means the sister concerns or your branches, or you can say those companies which have a common name as a parent company and they are working under that parent company. So such when you are consolidating means, say for example, if I take Unilever, have you heard about this company?
Yes, ma'am.
Yes, so it is having subsidiaries all over the world. So its Indian unit is called as Unistar Lever. So it's like that they are having units in different companies. So consolidated financial statements means you are going to show in total, say company A, B, C, D, the total of all the profits, all the financial balance sheet in one statement, and that is called as a consolidated. Means you are combining the records or say profit and investments, assets about different subsidiaries under one head. Okay, accounting for investment in associates. So a company may have business associates, they may have invested in those associate or partner firms. So any such investment made is, the details about it is given under Accounting Standard 28. Next, financial reporting for hyperinflationary economics means if there is a crisis situation, there is a constant rise in price, or you can say there is huge instability in prices. So constantly the prices are increasing, prices of raw materials or anything else which is needed for the business. So if in such a market you are working, you have a business in such a country where there is a crisis situation, there is lot of inflation which is shooting up because of maybe many reasons. Maybe there is a political unrest, or there is a flood, or there is a war, or say globally there is some problem, some recession is there. So if such thing is there where constantly your prices are changing and which is affecting your profits, so such records are given under Accounting Standard 29. It's clear? You can hear me? Yes?
Yes,
Yes,
ma'am.
ma'am.
Yeah, okay.
Yes,
And
ma'am.
okay.
Yes, ma'am.
Next is disclosure in financial statements of banks and similar financial institutions. So if there is any the partnership or investment made in any banks or any other financial institution, such details of investment, such partnership should be given under Accounting Standard 30. So next one is 31, which is joint venture. So joint venture is where? What is joint venture? Anybody? Any idea about what do you mean by joint venture? Yes, no one? I'll give you examples, at least with that you can understand. Okay, Maruti Suzuki, Hero Honda, they were having joint ventures. Now recently they have come out of the joint venture. So what do they do?
The foreign company
Hmm.
which is coming to India, so they become joint.
Take off
So that
business.
Okay, why this joint venture is normally done? What is the biggest benefit of doing a joint venture?
For
publicity,
easy
they can
growth.
get publicity.
You get easy publicity. Say for example, you have one company which is doing business in India. Say for example, Maruti. It knows the nerve of Indian market. What are the customers? What do they like? What they don't like? What is their budget? Everything. Okay, so you have a market leader who knows about the details of that, say, location or that country. Then we have one more partner which is good at technology. Okay, so if I go hand in hand with him or that company, I can make a better product. So I will have the advantage of technology. That company will have an advantage of market location and market details. So together they come up for few years or maybe for one particular project where they share their, say, investment, technology and market knowledge and so on, and they do business, and appropriately they uh, divide the profits between them. So any such joint venture, if any company is having the details about the joint ventures, how much you have invested, what are the sales returns, revenue, all these details are given under accounting standard 31. Then next is financial instruments, disclosure and presentation. Now financial instruments means maybe it may be stock, bonds, shares, units in mutual fund companies. So you are taking a loan from, say, a mutual fund company, from a debenture. So you are taking money from the market by using these debentures or bonds or stocks. So such details about how much money is taken, so what is the time period of the loan, how many debenture holders are there, or how much units you have bought, what is the rate of interest, when it has to be redeemed or repaid, all such details are given. So how much money is coming in, how much you have paid back, all details are given in accounting standard 32. Next, earnings per share. Now earnings per share means it is the net profit of a company. When we say net profit, it is the profit or the revenue minus all the expenses. Now when I say expenses, it contains direct expenses in the sense all those things which are involved in making that products. Okay, so maybe raw material, labor, overheads. Then administrative means the staff you need to take care of the office, the warehouse, then advertisement, distribution expenses, then interest paid, tax. So every small and big amount you spend on making the product, that all those expenses are minus the sales revenue. So that is called as the net profit after interest, after tax. So such profit after paying every small and big expenses, when you divide it by number of shares. Now what are shares? Shares are a part of the ownership. Okay, so you have, say, thousands of shares. So that net profit divided by the number of shares will tell you how much profit you are earning per share, means per investment made by people. So the details about it, how it is calculated, is given under accounting standard 33. So earning per share means the net profit after interest, tax divided upon the number of shares of that company. So if this ratio is higher, it shows that the company is sound, it is making profit, and by this what will happen is the market price of that company share in the stock market will rise, because people are interested to invest in the company because it is earning better. Next, accounting standard 34. This is interim financial reporting. Now, interim means it's like an interval. Okay, so we have our academic year, say financial year from April to March. Okay, so in between, say whenever the management needs, or in between the projects, we make reports so that you can know the status of our company, how is it is making profit, how much money is in debt, how much we have to pay back, what is the sales revenue. So such details of a, say, that's the reason why many companies are making quarterly profit statements. They're showing that every third month, after every 3 months, they're showing this is my profit loss, this is my balance sheet. So such reporting between a year is called as interim financial reporting, and that is done as per accounting standard 34. Then if you are shutting down any operations, if you are closing down any business, from that closing down, from the sale of that business, how much money has earned, what were the cost of closing down, all those things are given under accounting standard 35, that is discontinuing operations. Then in accounting standard 36, we are talking about details about assets, their impairment. Impairment means if there is any renovation, or you are changing it, or you are upgrading it, or it is old, you are discarding it, all such details are given under accounting standard 36. Then in 37, we are going to talk about any contingent liabilities or assets are there, or any provisions done. Now what is a provision? Provision means nothing but you are keeping something in advance aside, so that when the date of payment comes, you don't have to think about where will the funds come. Say for example, you have to pay tax every July. So for that, you're keeping some amount aside. Why? Because when you're doing business, there will be shortage of cash. So you're providing for something in advance, so that when the date of payment comes, you don't have to go around searching for a loan or saying that I don't have cash. So for such shortage, you are making provision. So details about any such provisions, so provision for tax or provision to pay dividend, provision for bad debts, all such provisions are given under accounting standard 37. Together with it, we also give a list of any contingent liabilities and contingent assets. Now, what do you mean by contingent liabilities? The liability means the loan or payment which may occur, may not occur. Example, say for example, you have a case in the court against your client, or maybe some client of you has put a case on you. Okay, so there is some case, and if this case, if you lose, you have to pay a heavy penalty. So if there is a point here, now there is a star mark saying that if you lose the case, I have to pay a penalty. So if any such thing is there, this is termed as contingent liabilities. It is shown like a star mark under the balance sheet, and also separately we make an account of any such payments. Why I'm saying contingent? It may happen, it may not happen. Okay, so the details of any such penalties, maybe you have to pay, or anything which may crop up, such details are given in contingent liabilities. Similarly, there may be contingent assets. Okay, so similarly, in losing a case, you have to pay the penalty. Winning the case, you may get some amount. Okay, so such assets also we are going to give the details about it under our accounting standard 37. Then next is intangible assets. Now what are intangible assets? Assets which you physically can't see. Okay, can you give me any examples of those assets which you can't see, feel or touch? Yes, anybody? Is there a possibility that you have an intangible asset in the company? Yes, anybody? What is an intangible asset?
Which cannot be seen.
That's what I'm asking, an example of it.
Goodwill.
Okay, goodwill. What is goodwill?
Good name of the brand.
Okay, the brand name. So just by saying that this company is launching a new product, it will be sold like hotcakes. Okay, because people trust your name. Okay, so even when you're selling the company, if your brand name is good, you'll get more money for the sale of your company. Okay, so similarly, we have copyrights, trademarks, okay, or any other intellectual property rights. So any such assets are there, the details about it should be given under accounting standard 38. Then last two, finally, financial instrument recognition. Okay, so here we are talking about details of any debentures, units, bonds, when they have to be redeemed, when are they going to be occurred, or when the interest is due. So all those details. So it is an extension of the previous one. So financial instrument, we have two accounting standards. So you're going to recognize here when I'm going to repay it back, or which are the debentures which are huge in number, what is an investment made. Then lastly, investment property. So investment property means if you are going to, you're thinking of investing in further growth or advancement, or this means like you are thinking of expansion and growth, and in a near future, or you have just recently acquired a new property. The details of such acquirement, what was the cost, what were the transaction cost, and all details are given under accounting standard 14. So whatever big small thing you're doing in the business, separately you have to give a note of everything, then only it will be considered as legal, because accounts are considered as a proof for any even frauds, and you can take it as a proof in case of any say legal matters. That's why we have to maintain all these accounts separately under different heads. Okay, so that's all about accounting standards, the details about it. You don't have to go in details, you have to just know these things. Now I want you to make an assignment on this.